Welcome to today's Explainer. Man, if you've been glued to your screens over the last 12 hours or so, you know exactly what we're dealing with today. We are right in the thick of a high-stakes, just incredibly fast-paced financial whiplash. I mean, overnight, the global foreign exchange markets were absolutely turned upside down. We're talking about a Friday session that is just packed with historic central bank decisions, massive vertical drops in currency pairs, and a much broader narrative of capital just flat-out fleeing the US dollar. So today we're going to break down exactly what happened while you were sleeping, why the market reacted the way it did, and most importantly, how this sets the stage for the rest of your trading day. Let's jump right into the briefing.
Okay, let's dive into this. Section 1. The yen flash crash.
158. Yeah, think about that number for a second. That is the level that had trading desks literally scrambling in the middle of the night. We saw the sheer breathtaking vertical drop in the USD/JPY pairing, and it violently smashed straight through that 158 floor. I mean, in the Forex world, a move this sharp and this fast, that's the textbook definition of a flash crash. It was a massive shock to the system, wiping out leverage positions in an instant and leaving traders honestly just completely stunned.
But, the market rarely moves in a straight line for long, right? The panic was actually pretty short-lived. By the time the morning session rolled around, that classic buy-the-dip mentality had aggressively re-entered the chat. Buyers stepped right in to scoop up the dollar on a massive discount, and they pulled the rate all the way back up to 160.57. But a roller coaster move like that, it doesn't happen in a vacuum. You don't just plummet through 158 and bounce back to 160 without some major institutional mechanics pulling the strings behind the scenes.
So what exactly triggered this whole shebang? Well, observers have confirmed it was basically a massive collision of two mechanical forces. On one side, we had a suspected direct currency intervention from the Japanese government, effectively stepping in to artificially pump up the yen. And on the flip side, this intervention sparked a violent unwinding of the carry trade. So investors who had borrowed cheap yen to buy higher-yielding assets, they were suddenly forced to liquidate and buy yen back just to cover their positions. This dual-force action was essentially a strategic maneuver to sort of clear the way and really test the resolve of speculators just hours before the Bank of Japan's highly anticipated morning meeting.
Moving right along to Section 2, BoJ holds rates steady.
And this brilliantly illustrates the historical context we're operating in right now. Even though they decided to pause today, borrowing costs in Japan are sitting at their highest levels since September of 1995. We are witnessing a monumental shift away from decades of zero or even negative interest rates. And that is exactly why every single meeting is being scrutinized under a microscope right now.
So ultimately, the Bank of Japan decided to hold the short-term policy rate steady at 1.00%. That's the level they established after their previous hike. Now, this decision was an 8-to-1 vote, which tells us there's a pretty strong consensus among the board, with only one member, Hajime Takada, actually dissenting because he wanted another immediate rate hike.
Now, you might be wondering, why didn't the market absolutely freak out? You'd expect a volatile reaction to a rate hold after a midnight flash crash, right? But the market actually stayed remarkably calm. Why? Because this 1.00% hold was already fully priced in by the experts and institutional investors. There was no unexpected hawkish shock in the official text to scare anyone. Instead, policymakers really focused their rhetoric on the upside risks to inflation driven by demand pressures, especially those linked to the ongoing conflict in the Middle East. And because there were zero hawkish surprises, those USD/JPY bulls felt incredibly comfortable using this as an opportunity to buy back in.
All right, Section 3, the dollar under pressure. Zooming out a bit, this turbulence over in Asia is really exposing some major cracks in the broader macro picture. The IC-US dollar index, the DXY, is experiencing the steep and incredibly painful drop, and it's currently struggling just to hold its ground around 100.3. This is a critical technical juncture, folks. Losing that major psychological support level of 100, that signals a much larger, very serious trend of capital outflow. Investors aren't just adjusting their positions anymore, they are actively moving their capital away from the greenback on a much broader scale.
And this dollar weakness, it isn't happening by accident. It is being driven by a brutal 1-2 punch on the economic data front. First up, we had yesterday's US GDP report, which came in at a highly disappointing 1.5%. I mean, that signals undeniable economic slowing. Second, the market is bracing for tonight's PCE inflation data, which everyone expects to show continued cooling. When you combine slowing growth with cooling inflation, you completely corner the Federal Reserve. The market is aggressively betting that the Fed simply cannot justify keeping interest rates this high for much longer. And that right there is what's pulling the rug out from under the dollar.
Which brings us to Section 4, Euro and Pound surge.
So if all this capital is fleeing the US dollar, where is it going? Well, we're seeing incredible strength in both the euro and the British pound, but they're being driven by entirely different central bank storylines. The EUR-USD has bounced back beautifully from new demand zones, currently trading right at the 1.1500 mark. The euro is enjoying double support here, benefiting from the weak dollar, for sure, but it's also being bolstered by a stubbornly hawkish anti-inflation stance from the European Central Bank. Meanwhile, the GBP-USD pair is surging, maintaining really strong upward momentum after yesterday's Bank of England decision. And what really lit a fire under the pound was the fact that 3 BOE members actively dissented and voted for a rate hike. That internal hawkish pressure created a massive springboard of support, basically keeping the pound pinned near multi-week highs.
Finally, Section 5, what to watch next.
So now that we understand the overnight mechanics, let's look at our actionable roadmap for the rest of Friday's trading session. The entire market is currently holding its breath, just waiting for the climax of today's Japanese narrative, Governor Kazuo Ueda's noon press conference. This is the main event. Investors are hanging on every single word to find clues. Are we going to see a hint that the Bank of Japan has the courage to hike rates to 1.25% by the end of the year? Because if his tone is perceived as too soft or even slightly dovish, the USD/JPY could skyrocket right back up to the 162 zone, which would undo literally all of the government's overnight intervention efforts in an instant. The suspense here is absolutely palpable. So the absolutely crucial takeaway is this. The storm out of Japan might have momentarily paused, but it can flare right back up the second Governor Ueda takes the microphone. You absolutely need to exercise extreme caution with any Japanese yen pairs right now. Are we just witnessing a temporary overnight blip, or is this the violent beginning of a massive global currency realignment? Make sure you secure your weekend positioning, because this volatility, it is far from over. Thanks so much for joining me for this explainer, and stay sharp out there.